Hey everyone, and an enthusiastic welcome to The Explainer. If you're the kind of person who loves dissecting high-quality businesses to figure out exactly what makes them tick, well, you are absolutely in the right place. Today, we've got a really fascinating deep dive lined up for you. We're putting Vijaya Diagnostic Centre, trading under the NSE ticker VIJA, right under the microscope. We're going to break down their business model, tear through their financials, and ultimately, we'll weigh their phenomenal execution against their sky-high valuation. Welcome to Stress-Free Investing Analysis. Personal notes. I am not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions. Okay, let's dive into this. Here is our agenda for today. 1. Decoding Vijaya Diagnostic Centre. 2. Their financial health and moat. 3. Governance and red flags. 4. The valuation dilemma. And 5. Our final verdict. Starting right off with Section 1, Decoding Vijaya Diagnostic Centre. Now, if you are from southern India, particularly around Hyderabad, you probably already know this name. With a solid 40-year legacy, Vijaya is actually the largest integrated diagnostic chain in the south. But here's what makes their revenue mix so incredibly unique. See, while most diagnostic chains focus heavily on just pathology, blood tests and that sort of thing, Vijaya combines routine pathology with high-end radiology, like MRIs and PET-CT scans, all under one roof. And because they run on a 92% business-to-consumer or B2C model, this integration gives them massive pricing power and builds incredibly sticky relationships with their patients. And here is the engine that really drives it all. It's their highly scalable hub-and-spoke model. Basically, they build these massive hubs for heavy radiology equipment and then surround them with smaller spoke collection centers. It's brilliant because it completely compresses the competition by capturing literally every diagnostic need a patient might have. Plus, their execution is just razor sharp. Check this out. When they recently expanded into West Bengal, their new hubs hit break-even in just 3 quarters. They completely smashed their own 12-month guidance. All right, let's move along to part 2, financial health and moat. Let's shift our energy up a gear here, because the financial clues we are about to uncover showcase a business of truly exceptional quality. The crucial point to look at is this negative 111 days. That's their cash conversion cycle. So what does this actually mean for you as an investor? Well, it means Vijaya gets paid by its patients in cash long before it ever has to pay its own vendors for reagents and supplies. The customers effectively pre-fund the daily operations. That is a massive and often overlooked competitive moat. Building on that absolute cash machine, just look at this accelerating growth. Over the last 5 years, their profit after tax has grown at a blistering 19% annually. In financial year 2026 alone, revenue jumped 19.5%, and their phenomenal EBITDA margins are holding incredibly steady above 41%. So they aren't just growing, they are growing extremely profitably. And the underlying safety of those profits? It's rock solid. These forensic checks are basically our ultimate stress-free indicators. We're seeing a Peter Trotsky F-score of 7 out of 9, an Altman Z-score safely deep in the green zone, and a Benish M-score well below the manipulation threshold. When you combine all this with an unmodified, completely clean Big Four audit, you have a business with a completely pristine bill of health. But we always have to look at both sides. Part 3, governance and red flags. Since no business is perfect, let's put on our investigator hats for a second, adopt a slightly more cautious tone, and examine the potential risks. First, the good news. There are 0 hard red flags. Literally none. There's no promoter pledging, and while foreign institutional investors have been selling, domestic institutions have aggressively stepped in and absorbed all of it. However, we do need to watch their rising lease liabilities as they expand. And more importantly, they just hired a new CFO, COO, and CTO all at the exact same time in early 2026. Now, while this definitely shows ambition for pan-India scale, a simultaneous transition of 3 major executives presents a short-term execution risk we absolutely must monitor. Over on the operations front, they're aggressively pivoting toward technology to defend their turf. They've rolled out Augmento. It's an AI radiology software specifically designed to slash turnaround times and improve report accuracy. Coupled with a planned, fully automated lab, this tech investment is going to ensure they stay light years ahead of the smaller regional competitors. Which leads us to the trickiest part, Part 4,
the valuation dilemma.
Now, what's really interesting about this next piece of data is that while we've seen a near-perfect business operationally, we now have to transition to the cold, hard reality of price. Just look at the sheer weight of this number, a price-to-earnings multiple of 73 times. At 73x, the stock is basically priced for near perfection. It means the market expects them to execute flawlessly for years to come. For any value investor, that leaves a very, very thin margin of safety.
So I want you to act as the judge here. On one side, we have the bull case. Massive tailwinds from rapid geographic scale into places like West Bengal, plus a growing and highly profitable wellness segment. On the flip side, the bear case. We've got the very serious threat of deep-pocketed, pan-India rivals like Dr. Lal PathLabs entering the South. If they do, that could easily trigger margin compression and a brutal contraction of that 73x multiple. So what does this all actually mean for you? Well, if we run a strict discounted cash flow model based on their current impressive cash flows, we get an intrinsic value of about 555 rupees. Now compare that to the current market price of around 1,260. This massive 55% premium essentially confirms that right now, the stock is trading purely on its high-quality momentum and execution track record, not on its intrinsic value.
Let's pull it all together. Part 5, the final verdict.
And this brings us right to the culmination of our explainer. Let's resolve this value investor's dilemma and deliver our final stress-free ruling. Let's see how the scenarios build out against the current price. In a bear scenario where growth slows down, you're looking at a 29% downside to around 900 rupees. The bull scenario could see it hit 1,600, but look at the base case target, 1,280 rupees. That implies essentially zero upside right now. It literally means Vijaya has to flawlessly execute 18 to 22% growth just to justify where the stock price is sitting today.
So taking that incredible business quality and weighing it against the stretched valuation, Vijaya Diagnostic Centre earns a final stress-free score of 73 out of 100. It is a phenomenal, incredibly well-run business for sure. But our verdict is watch to accumulate on dips. The ideal entry zone, where you actually get a decent margin of safety, sits around the 1,000 to 1,050 rupee level. The ultimate question you have to ask yourself is, are you willing to pay for tomorrow's perfection at today's prices?
Before we wrap up, a quick but important disclaimer. The analysis shared in this explainer is for educational and informational purposes only. I am not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions. If you found this deep dive helpful and want to stay updated with more stress-free investing analysis, please hit the subscribe button and press the bell icon so you never miss an update. I want to hear from you. Which Indian-listed company should I analyze next? Drop the stock name in the comments below, and it might be the subject of my next explainer. Thank you for watching, and keep your investing stress-free investing.